Hello, we are going to start chapter 1 this week, and I just want to make a little video to explain some of the major concepts that we need to know. This PowerPoint that I'm using with additional slides can be found in resources on MyMTI. You will also notice that this week in MyMTI, if you go there, there will be an assignment that is for you to go to your my accounting lab and do some problems. It also is going to notice that you will have a quiz that will open up on Wednesday. That's a vocabulary quiz that you need to have taken by Friday. And then next week, we will finish working on some accounting or chapter 1 information and also taking the test over chapter 1. So here is some important information. Chapter 1 has 4 basic things. It starts out with the understanding that you know a little bit about accounting. So the first thing we need to know is that accounting is the business of language, or language of business. It provides information to anyone and everyone that is involved or invested in the business, not only to your managers and the owners, but also to the outside people. If you're a public business, let's say like Nike, you honestly have to publicize that to everyone that has any shares that they have bought from your company. The accounting system, we look at what we call the accounting process, which means you analyze things, you record things, you classify. You're going to do a lot of reports, you're going to do a lot of interpretation, and then you also have to communicate these reports. Okay. Some business organizations is a sole proprietorship, a partnership, a corporation, and a limited liability corporation. Well, the first thing that we deal with a lot of times is ownership, sole proprietorship, and we also deal with corporations in this class. They're also classified as a service business, which is like a consultant firm, a service businesses, your hair salons, things like that. A merchandising business, so this is anywhere that you buy things, and a manufacturing. We're going to start out with a service business, and then second semester we actually work more with a merchandising business. Two things to know is like the difference between accounting and bookkeeping. Bookkeeping is the record function of the accounting process. So sometimes people will say they are a bookkeeper. That means that they are actually just recording the transactions. And accounting is what actually prepares the financial statements and involves a lot of the interpretation. One of the most important things that you have to learn in accounting is the accounting equation. No matter what you do, your assets are going to equal your liabilities plus your owner's equity. That is the most fundamental part to know in accounting, is the accounting equation. Assets equals liabilities plus owner's equity. Everything that we do is going to make sure that those equal. If that equation works, then you're going to have everything correct. This is very essential that you know. You should need to memorize that. Assets equals liabilities plus owner's equity. Like I said, is one of the most essential parts of accounting. When we look at assets equals liabilities plus owner's equity, we're going to look at each one of these things. An asset is something that you own. It is something that can be turned into cash at some point. So it's things like land, your supplies, your insurances, your equipment, your building, and cash, of course, those kind of things. Whether cash is savings account, checking account, in that situation, it doesn't matter. So an asset is anything that it has value, is like what I like to put on it. It also is things that can be turned into money or cash at any given time. Obviously, you're going to have to sell office equipment or sell a building, but you can actually use it to get cash. Our equities is the right of the financial claim to the assets. So think of our owner's equity or our equities as who is running the business or owns the business. So in a sole proprietorship, the owner's equity is the person who owns it. In a partnership, the owner's equity is the two partners that own the business. In a corporation, it's the shareholders. So as we look at equities, what they have and what we say is what their claim is going to be, if you take assets minus equities, you're going to get what's left in your liabilities. So kind of this equation works every which way in that part. So the equities is what someone financial claim can have for the assets. Our liabilities then is what we owe to other people. So these are things like if we buy supplies on account, or if we have insurance payable, sometimes tax payable. So it's any of that accounts payable stuff, money that we own, loans, if we took loans out, that is all, that's all that is just people who we owe money to. So as we look at this, our liability is the future obligation. It means that we have to pay that. So our assets equals our liabilities plus our owner's equity. So our liabilities is the rights to the creditors, and the owner's equity is the rights of the owner. Those two things is what equals the assets. So when you really look at that, you know, okay, what we owe the people and what we owe ourselves should equal the money that we have in our assets. Our capital account is the owner's investment in a company. It does not always mean cash. It includes any asset the owner has in the business. Like I say, it could be a building, it could be equipment, but that is a capital account. Okay, we're going to talk about some transactions right now. I just went through a bunch of terms in a hurry, and I want to spend a little bit of time going through some transactions that are very basic transactions for us. One is Maya invests $6,000 cash and $200 of office equipment in the business. So basically what this is saying is that the capital account is Maya Wong Capital. What we're saying is that she is claiming that she has capital of $6,000 cash and $200 equipment. So it equals $6,200. So if you look at that, our assets is $6,200, our liabilities is $0, our owner's equity is $6,200. It equals each other. In another situation, a law practice buys an office equipment for $500 cash. So we already know we have an asset as office equipment. We have cash there. So as we put this in, we are subtracting from our asset cash $500 that we paid, and we are adding $500 more of equipment to it. So if we still add that up, you're going to see the assets still equals your liabilities plus owner's equity. Nothing has changed in Maya Wong's capital account, only in the asset side. So what you will notice is that you always do something to both sides of the account. So if I'm going to add something in the assets, then I will add it to the liabilities or the owner's equity. If I subtract something from the assets, I'll subtract it from the liabilities and owner's equity. But if I'm using two asset accounts, I'm going to subtract and add in that asset account. Just like this, with office equipment and cash, I'm using two asset accounts. Two accounts that have value. It could be supplies is another one we do a lot, where you pay cash for supplies. So that means you're subtracting cash and adding to your supplies account. So the shift in assets is the makeup that everything else changes the same or stays the same. Another transaction is when you buy additional office equipment on account. Now, what this is going to do, anytime you see on account, it means accounts payable. That means you're going to pay for it later on. You bought it on account, you have no money right now. That's why I like to think about it a little bit. On account, I have no money right now. So then that way, you know, you're going to increase your liabilities and you're going to increase your office equipment. As you can see here, you're increasing both your office equipment and your liabilities. The second part of the chapter deals with balance sheets. So as we go through the balance sheet is a history of the company. It shows reports, financial positions of a particular date. Your assets are going to be left-hand side. Your liabilities and owner's equity is going to be in the right-hand side. And this is what just basically shows how many assets you have, how many liabilities you have, and the owner's equity amount. So as you look at this balance sheet, you can see pretty easily how it's listed. The assets on the left-hand side, you add them up, total assets, liabilities, owner's equity, and then total owner's equity. This is a great example of it. A lot of times you will just have to put in the blue accounts and they will have everything else in for you. But these are the total balances that go in here. The next part about our accounting equation is that we also expand it to what's revenue, expenses, and withdrawals. Revenue is the amount of money that you earn performing a service or selling goods. It increases your owner's equity, and it is only recorded when it is earned. Assets increase if the cash is the client pays right away. Accounts receivable, which is things that you're going to receive, is the client promises to pay you in the future. So with your revenue, if you have sold merchandise or sold a piece of furniture, your revenue is going to increase, and so is your accounts payable if you sold it on account. Cash would also increase if it's going to be paid right away. Your expenses are anything that you incur trying to create revenue. So this is things like your electrical bill, your utilities, maybe your phone bill, maybe salary expenses you have to pay your employees, your taxes are in there. And so that's all those kind of expenses that you have that you need to have to be able to run your business and create revenue. They can be paid in cash or they can be charged. We also talk about net incomes and net losses. Our net income is when our revenue is greater than our expenses. And net losses when your expenses is greater than your revenue. So when we figure that out towards the end and we do what we call an income statement, if your income is more or your revenue is more than your expenses, it's net income. If your expenses are more, it's a net loss. Another thing that we have that affects capital is what we call withdrawals. So withdrawals is basically just when a owner takes some money out of the account prior to when they're supposed to actually get it. So you know you're going on a trip, so you want to withdraw $300 out so you can do it. It's not an expense. It's called withdrawals. It only affects a capital account. And that kind of explains it. So here's some transactions in the PowerPoint you're going to see that actually talk a little bit about the extended, and it does a very good job of showing that. So I would go back to the PowerPoint and also in your book as you're reading through your book, being able to point these out and look at these different transactions. And this is what your actual journal would look like. So you're going to see that you have your certain cash accounts, what is increased and decreased, how things work, and this is a very good example. Now there's two other reports that you're going to be working on in this chapter also. You will go through those as you are working on things, and I will review those actually next week to make sure that we understand them. You can guarantee that there'll be videos for each chapter and some instructions on that. So always check your news and announcements for what you need to do this week.